Hello and welcome to the Loan Officer School Test Preparation video course. I'm Charmin Lane and I'm going to be your instructor for the next few hours. This program is going to be kind of an overview of everything that you're going to need to know to pass your mortgage licensing exam. Now remember, you have to understand all the foundation and the concepts of this material. You can't just study Q&A and expect to pass this exam. This test is tough. So you want to make sure that you're utilizing all the materials you received in this package in order to pass your exam the first time. Now, let me tell you a little bit about myself. And first off, this is where you can reach myself and Loan Officer School. This is me. I'm going to be your instructor. Most people call me Char because the toilet paper jokes got old by about the third grade. This is our phone number at our office, 866-623-1250. Our website is loanofficerschool.com and our email address is operations@loanofficerschool.com. So let's go ahead and dive into the program and see what you're going to need to go ahead and know deep down and dirty so that you can pass your exam. Remember, utilize all the materials you receive in this test prep package to make sure that you can pass that exam the first time. So NMLS, that is the nationwide mortgage licensing system. This is the organization that regulates and creates the material that you need to know in order to get a license. First thing you need to do is go to the NMLS website and obtain yourself an NMLS ID number. If you have any trouble, just let us know and we have a step-by-step instruction guide to help you get your NMLS ID number. You really can't proceed without that. You have to have an ID number before we can submit your education credits to NMLS. You have to have your ID number before you can schedule your exam. So really that's the first place to start. After you've gotten your NMLS ID number, you want to sign up for a 20-hour pre-licensing education. Now, please make a note. Some states require more than the 20 hours, or in your 20 hours, you have to have certain state limitations or state requirements. If that's the case, you want to make sure you're getting the right program so you don't have to go back and repeat any of your hours. Every state requires a national exam. This national exam is included with what's called the Uniform State Test. This national exam has the Uniform State Test in it no matter what state you're in, so you have to make sure you know that material. But also, you may be required to take a state exam as well. It's your job to go onto the NMLS website and look at what is required in your state. So see if you have to take a national with UST exam, or do you have to take the national with UST and the state exam as well. There's about 40 plus states now that are doing just the national exam, but another dozen or so states are still requiring the separate state exam. So every state's a little different. Make sure you know what your state requires. You're going to have to submit some fingerprints. You'll learn a little bit later on why. One of the laws that NMLS falls under requires fingerprints because we need to make sure that you fit the right background. You can't have any felonies within the last 7 years. You can never have had a financial felony. So we'll get into more of that in a little bit later on. But you have to get fingerprints. If you have a criminal background, you might want to double check and see if whatever happened is something that would prevent you from getting your mortgage license. You're also going to have to get a credit report. Kind of makes sense, right? You shouldn't be giving other people financial information and guiding them on what their finances should be if you haven't been so great with your own. You'll talk about a little bit later on about what that credit report is looking for. We're really just looking for major problems, like we're looking for past tax liens or things like that that are still open and haven't been paid yet. We're going to cover a little bit again later on of what we're looking for on that credit report that could prevent you from getting your license. But just some bad debts or some collections or maybe even a foreclosure or bankruptcy, not going to eliminate you from getting your mortgage license. All right, just some major things like, again, past due tax liens or things of that nature. And even sometimes people who have had tax liens can still get their mortgage license if you're on some type of a payment plan. But we're going to come back to that a little bit later on. All right. You always want to make sure that once you've gone through the grueling nature of what it takes to get your mortgage license, that you keep it current. Every state requires a minimum of 8 hours of continued education. In the event that you let it lapse, you're going to have to take more education and you may be required to retest. And trust me, nobody wants to do this exam more than once. So pass it your first time and never worry about taking it again. Keep your license current. But again, when it comes to continued education, all states have different requirements. Some of them are just 8 hours. Some of them have more requirements for the state content. So make sure you check your state's website to make sure that you're meeting the education requirements. All right, this test is 100% computerized. And you'll know the moment you finish up that exam whether or not you passed. There are about 125 questions. Only 115 of them are scored. The other 10 are always implemented in the exam to make sure that they're always constantly rewriting the test questions. So basically nobody can cheat. If your best friend takes the exam, they're going to get an entirely different version than what you get. So make sure you know all the material with all of the concepts and the foundation understood. All right, now when you go to your testing center, this is not something you do online. This is something you have to go to a proctored test center in order to complete. You have to take your driver's license or some other type of federal issued or state issued photo ID. They want to make sure that the person who has signed up for the test is actually the person taking the test. You might feel a little bit like you've just gone to visit someone in prison. Not that I've ever done that, but that's what the concept kind of feels like. What happens is you're going to get there. They're going to make you roll up your sleeves and pull up your pant legs and empty out your pockets. If I were wearing this jacket, they'd make me take the jacket off because maybe I have secret panels inside or something that I have the answers written in. So wear long sleeves, they keep the rooms kind of cool, and make sure you don't bring anything else with you. Whatever else you do bring with you is going to need to go into a locker where it can be safely secured and you go in with just the items that they give you. So right here, you will be given a regular math calculator. Do not worry about bringing your own. You cannot take it in. They're going to think it's some Mission Impossible 007 calculator that's going to just spit out all the answers for you. So they want their trusted calculators that they know have not been tampered with. All right, they're going to give you that math calculator. They're going to give you a whiteboard and a pen and a locker key. That's all you get to take into the testing center. In that locker, you're going to put everything you brought with you. Your car, your watch, your keys, everything that you bring with you is going to go in that locker. Your purse, your jacket, everything you bring is going to go into that locker. So really, come lightly loaded. Don't bring a lot of stuff with you. Everything you need will be given to you at the testing center. You just need to make sure you bring a state or a government-issued ID. Again, that's what I was just saying right there. All right, now we're going to start diving into all the information. There's about 20 mortgage laws that you need to know all the ins and outs to in order to pass this exam. So you want to make sure that you know all the highlighted information, but all the little details as well. I kind of call this test prep video, this is like your steak, okay? But you're going to need the potatoes and the peas and the carrots all together in order to pass your exam. So this is going to be all the highlights and all the main big pieces, but there's a lot of little parts that are going to be on your exam, so make sure you're studying everything you are given in order to pass your exam the first time. So there are 3 really big items on the exam. It is RESPA, TILA, ECOA, and SAFE. I'm sorry, that's actually 4, I can't count, and I'm in the mortgage industry. All right, so 4 big items. RESPA, that stands for Real Estate Settlement Procedures Act. TILA, which is the Truth in Lending Act, ECOA, which is the Equal Credit Opportunity Act, and SAFE, which is the Secure and Fair Enforcement Act. You are going to need to know all the ins and outs of all of those items, okay? So make sure every fine detail that you got in your 20-hour program, you are referring back to so you have all of the information that you need. Now, there are 2 main tax forms that we use in the mortgage industry. They're called an 8821 and a 4506T. The 8821 will actually get you a copy of the tax returns that were filed with the IRS. Back in the day, there was a lot of fraud in the mortgage industry, so customers would alter their tax returns so they could qualify for a loan, but they'd send something else entirely different to the IRS. Well, mortgage companies have kind of figured this out, so they'll take the copy you give them, but they're going to confirm it to make sure that the IRS got the same documents that you sent with them as well. So make sure that you know what the differences are. An 8821 is an actual copy of the tax returns. The 4506T is a transcript of the tax returns. So make sure you know that difference. Now, when it comes to laws and regulations, There are 5 laws that are also known as a regulation. Ultimately, they're the same thing, but you need to know both of the terminologies. So ECOA, Equal Credit Opportunity Act, is the same thing as Regulation B. Now, as I said a moment ago, the 20 laws that you need to know about, 5 of those laws are also known as a regulation. So you need to know which laws are regulations and what they mean. So Regulation B, like Bravo, Regulation B is ECOA. It's the Equal Credit Opportunity Act. Well, here's a way that you can remember that. Don't you want all people to be equal? BE, right? B equal. So you can remember that Regulation B is the Equal Credit Opportunity Act. Now, this law was created in 1974. Some people ask you really need to know the dates. It's a safe bet. Sometimes you're going to have those oddball questions that ask you what date a law was implemented. Well, if you don't know that and it's just 1 or 2 questions, you're probably going to fail because most people fail this exam with like a 74, 75%. Actually, I'm sorry, 75 is passing. So some people will fail with just 1 or 2 little questions that they missed. So make sure you know all the details of, again, all of the laws. The next one is Regulation C. Regulation C is what we call HMDA, HMDA. That stands for Home Mortgage Disclosure Act. Now, do not worry, we're going to get into all the nuts and bolts of all of these programs here in just a little bit. The next one is Regulation V. V and F, they kind of sound alike, right? Or you can do the letter V and turn it to the side and it makes it F. That's the only way I thought of to remember this one. So you're kind of on your own with that one, unless you like my little V twisting it to an F scenario. Regulation V, like Victor, is the same thing as FCRA. Some people call it FACRA, but that throws an A in the center that kind of throws you off a little bit. So I call it FCRA, which is the Fair Credit Reporting Act. That law was created in 1968. It's been around a nice long time, and we're going to again cover all of the details of what this law entails here in just a moment. Now, Regulation X is really one of the mortgage law powerhouses. It has a lot of information in it. Regulation X is RESPA. That's the Real Estate Settlement Procedures Act. This is a law that requires a lot of disclosures and other items to be sent out to the borrower so that they really understand what they're getting themselves into. All right, now how do you think I remember this one? Respects your borrower, right? If you respects your borrower, which is RESPA with an X, and the X is the regulation name. So Reg X is RESPA. Remember to respects your borrower. The last major regulation is Regulation Z, okay? Z like Zulu. Well, TILA, the Truth in Lending Act, is the Godzilla of the lending laws. That is how I remember that Reg Z is TILA, because TILA is the Godzilla of the lending laws. And this law has been around for a nice long time as well. It's been modified and adjusted many, many times over the years, but TILA is the Godzilla, and it was created in 1968. Now, a few other things that you want to make sure you remember. SAFE, that stands for Secure and Fair Enforcement. Many people come back and say, where is the A in SAFE? I don't hear an A, because most of the time you don't use and. Well, in the SAFE Act, to make it a fun little acronym, NMLS decided to, or Dodd-Frank, they decided to call it SAFE and include the A, which means and. So it's Secure and Fair Enforcement. That's a fairly new law. It's only been around for, less than a decade, or around a decade. This was created in 2008 with that last big mortgage crisis. Right? The FACT Act is another new law that was created because of the mortgage crisis, or partially because of the mortgage crisis. The FACT Act stands for Fair and Accurate Credit Transactions. The way I remember FACT Act and what it's about is because if something's not factual information, it's fraudulent information. So fact equals fraud. This is the law to protect your information from fraud or from identity theft or things of that nature. And that law was created in 2003. Another big law that we hear a lot about today is Gramm-Leach-Bliley, GLB. Now, for those of you who don't know, Gramm-Leach-Bliley, these are 3 senators or congressmen. Okay, these 3 senators, and if you think about it, what is it a senator's job to do? Shouldn't a senator or a congressperson protect the interest of the people they represent? Not saying that actually happens, I'm just saying it's supposed to. So senators and congresspeople, what they do is protect the interests of the people that they represent. Having said that, the 3 main parts of Gramm-Leach-Bliley is SPF. What is SPF? Sun protection factor, right? So senators protect the people, sunscreen protects your skin. You can remember that SPF is safeguards rules, pre-texting, and the financial privacy rule. So sun protection factor, SPF, and your senators, they're both about protection, okay? Now there's a new category of loans, not really new actually, it's been around for a while, but it's called higher priced loans. This is a category that has some additional conditions and requirements that go along with it in the event that you do a loan under certain characteristics. If your loan or the loan you're doing for your customer has these characteristics in it, then you need to make sure that you've met the additional requirements that fall under the category of higher price loans. Now the key factor under higher price loans is 1.5% over the average prime offer rate. I'll explain what that means a little later on. Again, this is your highlights. 2.5% on a jumbo loan. If you don't know what that means, I'll explain that a little later on. And 3.5% on a second mortgage. So again, if you're 1.5%, 2.5%, or 3.5% over the average prime offering rate, you have a higher price loan, and you have some additional disclosures and protections that you need to make sure that you put in place for the borrower. The next law is called HOPA, the Home Ownership and Equity Protection Act. Okay? HOPA is also known as Section 32 or high cost loans. This law can be really tricky because it's one law known by 3 names. It's called HOPA, high cost, or Section 32 loans. So you've got to make sure that you know all 3 of those names pretty much mean the same thing, or they refer to the same law. Now, another one is called affiliated business arrangement. The key factor on this is this 1%. Basically, it means that if you have an affiliated business, which means you own a portion of another business, at least 1% or more, you have to disclose that affiliated business arrangement to the customer. So let's say I'm a mortgage broker, but I also happen to own an escrow company. That's my business, and I have the real estate or the mortgage business. I have to disclose to my customer if I own 1% or more of another business that I'm using on this transaction, I have to explain that I own portions of both of those businesses. Basically, it's so that the customer knows I'm making a profit on more than one part of this transaction. They have the right to know that so they can decide if they want to use someone else for the other piece of the transaction. Another big law that's really important in our industry is called the Fair Housing Act. That law has been around really a long time, 1968 again, along with some of the others. Fair Housing Act is about housing, okay? It's about renting, leasing, buying, or selling living space, okay? So anything that falls under any of those categories, buying, selling, leasing, or renting, falls under the Fair Housing Act. All right, and again, we're going to get into all the details here in just a minute. The next major law is called HPA. I have this little rhyme that says HPA equals PMI, okay? And this is how I do it. HPA, there's 2 consonants and a vowel, and it equals the same thing, which is 2 consonants and a vowel. This is back from your 3rd grade, English class, right? So HPA equals PMI. HPA stands for Homeowners Protection Act, and that law is solely about private mortgage insurance. If you don't know what that is, don't worry, we're going to cover that here in a moment. Civil Rights Act. The Civil Rights Act. Any question on your exam about the Civil Rights Act, the answer is going to have something to do with race. This is the longest standing law in our mortgage industry. That law was created in 1866. Yes, I really did say that right, 1866. But remember, this law is all about race. Civil Rights Act is all about race. Now, another one that will never, ever, ever be abbreviated, these two are not going to be abbreviated simply because they have the same abbreviation or the same first letters. So, Community Reinvestment Act, all right, this one was created in 1977. And a lot of these laws are kind of logical. So, if you see Community Reinvestment Act and it all goes out of your brain what that law means, just remember this. It's a law that requires companies to reinvest back into the community of where they have a business. So if I have a business in Irvine, California, then I have to, and I have a physical location, I have to be sure to lend to the people in Irvine, California as well. That's the Community Reinvestment Act. Medea. Okay, a lot of people have said, does this have anything to do with Tyler Perry? No. I know there's a movie where the name was Medea, but that's not this. Medea in the mortgage industry stands for Mortgage Disclosure Improvement Act. And it did exactly what it sounds like. Okay? In 2008, because of the mortgage crisis, the federal government stepped in and said, we need to do a better job on our disclosures. Some of this information doesn't make sense to consumers. We need to revise it so it's easy to understand. So the Mortgage Disclosure Improvement Act was created to improve the way disclosures were given. But again, if you forget and you just remember the name, it pretty much tells you what it does. It's an act that improved the way disclosures were given in the mortgage industry. So sometimes, like I said, if you get caught up or stuck, just go back to the name of the law and try and make a logical conclusion. Next one is HERA, H-E-R-A, HERA. Okay, that stands for Housing and Economic Recovery Act. This law was created in 2008, again because of the mortgage crisis. HERA is a bigger law at the top, but I'm going to create like a little organizational chart for you here in just a moment. It's going to show you what laws fall under what laws. But the SAFE Act is just a part of HERA, the Housing and Economic Recovery Act. Well, you know how I remember that? In order to be safe, you need to have a HERA, like a girl hero, right? So in order to stay safe, you need a HERA, and HERA is the bigger law at the top, and the SAFE Act is just a part of it. All right, now, again, you have to take an exam in any state you want to have a mortgage license in, or basically you want to do loans in. And we're going to cover a little bit later on who needs a license and who just needs to be registered. Because if you work for a federal depository institution, you don't need to have a license, you just need to be registered. But if you're going to work for any other organization, you have to have a state license. So in order to get that, you need to realize that things have different terminologies in different parts of the country. Closing is the same thing as signing all of your important loan documents. So on the West Coast, they call it signing because they don't close at the same time, okay? But on the East Coast, they call it closing because you're closing the loan at the same time you're signing your important loan documents. So you need to make sure, no matter where you are in the country, you understand that those two items mean the same thing. So you will likely see closing on your exam because this is an East Coast written exam and it used East Coast terminology. Having said that, escrows and impounds is kind of the same philosophy. When you have an escrow account, it means that you are collecting, or the lender is collecting, for taxes and insurance in your mortgage loan payment that you make every month. Well, certain states call this something else. It also is referred to as impounds. Okay, so you need to remember escrows and impounds means the same thing, and it means the lender is going to collect taxes and insurance in your monthly mortgage payment that you make to your mortgage company. All right? Then there's something called acquisition cost. Basically, it's like what it sounds, or it means exactly what it sounds. Acquisition cost is the purchase price or the appraised value plus closing cost minus any seller credits. That is your acquisition cost. So if I'm buying a house for $100,000, but there's $10,000 of closing costs, and the person I'm buying the house from is willing to pay some of my closing costs, say it's $5,000, then the total acquisition cost is $105,000, okay? It is the purchase price or appraised value, whichever one is less, plus the closing costs minus any seller credits. Now, if the seller's going to do repairs, that's not the same thing. All right, it's only if the seller's going to give you money to pay some of your closing costs. All right, next important thing to remember is this acronym. You've probably heard about it a lot, which is Fannie Mae. Now, you may have seen it spelled out, F-A-N-N-I-E-M-A-E. Well, that was derived from this acronym, FNMA. That stands for the Federal National Mortgage Association. Fannie Mae is a large organization that was created back in the days of President Franklin Roosevelt to give banks and mortgage companies a place to sell their loans off to, because if a bank ran out of money, they were no longer going to be able to lend, and that slows down the economy. So when it comes to Fannie Mae, there's a large organization that allows companies to sell their loans off to this organization that will buy the loan and give you the cash for it so that you can utilize your cash to continue lending to more people. So that's what Fannie Mae does. And kind of a big partner of Fannie Mae is another organization that was also created to kind of with different guidelines, although they both merged now and they pretty much do the same thing. So there's Fannie Mae and there's Freddie Mac. Now, I have no idea how FHLMC equals Freddie Mac. So I think they should have called it Phil Mac. 20 bucks says the guy who created this law, his name was Fred, is my guess. So FHLMC stands for Freddie Mac, and that is the Federal Home Loan Mortgage Corporation. Right, and they do the same thing that Fannie Mae does. It's a avenue in which companies can sell their loans to so they can free up their capital and continue to do loans for the general public. All right, conventional. Conventional is a term that you absolutely need to make sure you understand. Conventional means not a government-insured loan. Now, there are three main government-insured loans in the U.S. They are FHA, VA, and USDA. If your loan is anything other than one of those three, FHA, VA, or USDA, you've got a conventional loan. It just means it's not government-insured. And that leads us to our next term, which is conforming. Conforming limits vary throughout the entire country, and some areas have higher numbers and others have lower. And that's just because if you were in San Diego, California, your house is going to cost you more than if you were buying something in Tulsa, Oklahoma. So the limits in Tulsa, Oklahoma are going to be lower than that of what's in, again, San Diego. San Diego has a high cost category associated with it. So conforming, for the sake of the exam, means $417,000 or less, and the loan conforms to the Fannie Mae or the Freddie Mac guidelines, all right? So you could have a conventional loan that is not conforming. A lot of companies do loans that fit their own profile. They're gonna hold on to the paper and not sell it off to Fannie Mae or Freddie Mac. That term would be known as portfolio. But if your loan fits the requirements of Fannie Mae or Freddie Mac, and the loan amount is less than $417,000, is $417,000 or less, then you have yourself a conforming loan. Now, a traditional loan has one type of loan, a 30-year fixed rate mortgage. That whole sentence altogether. A 30-year fixed rate mortgage is a traditional loan. Anything other than the 30-year fixed rate mortgage is known as non-traditional. Now, your term could still be 30 years, but if that rate is going to adjust, or you're going to have a balloon payment due, or if there's going to be any variation in the rate or the payments during the term of the loan, that is going to be a non-traditional mortgage product. Okay? Traditional means 30-year fixed rate loan. Non-traditional is every single other type of loan out there. All right. Now, CFPB, you've probably heard a lot about the CFPB. They've got a lot of buzz going on in the world today. CFPB stands for Consumer Financial Protection Bureau. And ever since the 2008 crash, the CFPB actually was implemented in 2010. And this law does exactly what it sounds like. They are enforced to instill protections for consumers in the financial sector. This affects pretty much anything and everything having to do with finance. It affects stockbrokers and accountants and any type of trade organization, everything having to do with finance, even people who do a check cashing store because they're dealing with money. So anything that's a financial transaction falls under the CFPB. They're the new overseeing agency and the promulgator. I always wonder, what does that word mean, promulgate? Well, usually it's the one that creates and implements laws. So, and other organizations typically enforce them. So CFPB is your overseeing agency. They promulgate laws, but the FTC is the one that actually enforces them. All right, so all mortgage laws fall under the CFPB. However, one exception to that rule, the Fair Housing Act. The Fair Housing Act may not always be a financial transaction, right? It may not be buying or selling a house or refinancing a house. It could just be renting an apartment. Well, that has nothing to do with finance, right? So because the Fair Housing Act covers a little bit more than just finance, the Department of Housing and Urban Development are the ones that facilitate the Fair Housing Act. So HUD, the Department of Housing and Urban Development, is basically the overseeing agency for the Fair Housing Act. All right, now let's dive into the nuts and bolts of each and every one of these laws and programs and terms and what you're going to do with it. NMLS again stands for the Nationwide Mortgage Licensing System and Registry. Now this is again what I was saying before. If you're working for a federal depository institution, you don't need to have a license. You could work for a local credit union, but it's probably FDIC insured and it probably falls under the OCC, which is the Office of the Comptroller of the Currency. If you work for a company that does that and you're paid by W-2, you do not need your mortgage license. You do have to register with the NMLS. They have to do a background check and a credit check, and you have to file with them, but no testing or education is required for you. This program is designed to get everybody state licensed, okay? So this is all the details of the NMLS. They were started in 2004, all right? And they were created by the Conference of State Bank Supervisors, which is the CSBS, and the AARMR, which is the American Association of Residential Mortgage Regulators. So the NMLS was created by the CSBS and the AARMR. There are a lot of acronyms in the mortgage industry. You've got to make sure you know what each one stands for. All right, again, NMLS is that centralized and standardized organization that makes sure that all people in all states, no matter where they work, are falling under the same rules and requirements in order to be a mortgage loan originator. All right, the online system that was built for the NMLS was created by FINRA. You've probably heard that term before, FINRA. That is the Financial Industry Regulatory Authority. They do a lot more than just mortgage. If you had your securities license, like a Series 6 or a 7 or a 63 or a 65 or something securities related, that would fall under FINRA as well. All right. So now what we're going to do is dive into all of your mortgage laws. There are 5 categories of information in this test prep video. The first piece is federal mortgage laws, okay? This is going to be a big portion of your exam. I'm going to go over that here in just a moment. All right, you're also going to need to understand different sections like general mortgage knowledge, mortgage loan originator activities, ethics, and the UST section of the exam. So for right now, let's dive on in to federal mortgage related laws. Okay. So federal mortgage related laws. The first one we're going to discuss here is the SAFE Act. The SAFE Act is Title V of HERA. I said this earlier. In order to be safe, you need a HERA, like a hero, right? That stands for Housing and Economic Recovery Act. This is a huge key component of HERA. HERA is created in 2008. In 2008, the SAFE Act was created under HERA to make sure that we're basically regulating mortgage loan originators, to make sure y'all are doing things the way you're supposed to be doing them. This law establishes the minimum necessary requirements in order to get a license. What the SAFE Act does is it allows for people to get employment information, employment records, and employment background. So if you had a file that was reported against you, if you were released for fraud or let go for fraud, that's going to show up on your NMLS record. This information will follow you no matter where you go. All right, so you're always going to have the same NMLS ID number, and that number is just going to go with you from one place to the next. No matter where you go, what state you're in, how many states you're licensed in, you're always going to have the same NMLS ID number. This law requires that loan originators operate and act in the consumer's best interest. You heard me earlier say the term Consumer Financial Protection Bureau. This law and that organization is all about protecting the consumer. They don't care about you, the loan officer. The only thing they care about is that you're doing right by the borrower. So make sure you are always looking out in the customer's best interest. This law also facilitates responsible training in the mortgage market. You've got to have the right education and be doing the right behaviors in order to get and keep your mortgage loan originator license. Also, the SAFE Act manages consumer complaints. You could go onto the NMLS website as a consumer and file a case against or file a complaint against a mortgage loan originator or a company. And the consumer has access to your records. They can see if any other complaints have been filed against you. Now, when it comes to the SAFE Act and licensing, the unique identifier number is the same thing known as your NMLS ID number. This is what I was saying before. You will either be federally registered or state licensed. If you are federally registered, it means you work for a federal depository institution as a W-2 employee. And if you're not, then you're going to be state licensed. State licensed means that you work for some organization that is not a federally chartered or a federal depository institution. You have to have your license. And every applicant, regardless of whether or not you're getting a registration or a license, has to have a background check, can never have had any license revoked historically in the past, can never have been convicted of a felony. Basically, like financial felonies are the ones that if you've ever been convicted, you are never going to get your mortgage license. This is things like breach of trust, breach of contract, money laundering, embezzlement. Any financial felony, you are never getting your mortgage license, which kind of makes sense because otherwise it's like letting a third grade teacher who has history of being a pedophile. Not going to happen, right? So never can be convicted of a financial felony. If you've ever been convicted of any other felony, murder, rape, assault, battery, something like that, but not in the last 7 years, then you still have the possibility of getting your mortgage loan originator license. All right, so no felony within the last 7 years of any kind, no financial felony ever. Now, as I said before, if you're getting your mortgage license, not being registered, but your mortgage license, you're going to have 20 hours of pre-licensing education. Now, remember again, in this video, highlights all the steak and the potatoes, right? You still need all the peas and carrots. So make sure that you refer back to your 20-hour education program so that you can get all the nuts and bolts and really be prepared for this exam. So in your 20 hours of approved pre-licensing education, you have to have 3 hours of federal laws and regulations, you have to have 3 hours of ethics, and 2 hours of non-traditional mortgage products. Now, I know you're thinking, well, that's only 8 hours, Shar. What are you talking about? Where's the other 12 come from? Well, that can be elective material. The loan officer school test preparation programs and all of our 20-hour courses don't really look at what's the word I was just using? The elective material, what we do is give you everything you need for the exam. But technically, it only needs to include anything mortgage related. But again, the loan officer school programs are designed to give you everything you need to be a competent and confident loan officer, as well as pass your exam the first time. So refer back to that material for all of the fine details. All right, so these are the three topics, or the three main things that are required to be in your 20 hours of education. Now, this is what I was referring to a little earlier. These are your 5 categories that are on the exam. Federal mortgage-related laws, that's 25% of your exam. 20% of your exam is general mortgage knowledge. General mortgage knowledge is things like terminology and some of the acronyms. It's understanding the language. It's the programs and the products, okay? Mortgage loan originator activities is a lot of your math. That's, do you know your formulas? Do you know how to calculate a loan to value, a debt ratio, how to acquire the acquisition cost? This is all of your math. Usually something to do with numbers is going to fall under mortgage loan originator activity. Ethics is another 15%, and the Uniform State Test, abbreviated as UST, is another 20%. So here's what you need to realize. Between federal mortgage-related laws, ethics, which is a lot about do you know and understand when you could be breaking a law, and the Uniform State Test, which is all about the SAFE Act, that's 60% of your test. So if you just studied those 3 categories, you're almost to the passing line. You need a 75% to pass this exam. The majority of that information is going to fall under laws, because those 3 things equal 60% of your test. So no bones about it, no one understands the federal mortgage-related laws. Now, certain states may require additional state topics. So, for example, state of New York, they require 20 hours of pre-licensing education, the same things that we were talking about before, the federal laws, the ethics, and the non-traditional mortgage products. State of New York also says that out of your 20 hours, you have to have 2 hours of New York law. California says you have to have an additional hour of California law. Every state's a little different. Some of them say just the 20 is fine, and the 12 hours of elective, fine. Other states say in that elective, in that 12 hours, somewhere in there, we need X number of hours on the state laws, all right? Now, when it comes to renewing your license, this is an annually renewed license. Every year you have to take continued education. In that continued education, it has to have 3 hours of federal laws, 2 hours of ethics, and 2 hours of non-traditional mortgage products. You may be wondering, what's with all this education? I don't need to tell anybody how the mortgage crisis of 2008 devastated many families. Loan officers and mortgage people lost jobs across the board all throughout the world, all right? But consumers really paid a lot of the price as well. People lost their homes, filed bankruptcy, filed foreclosure, and a lot of that was in part due to unscrupulous mortgage loan originator activity. So to make sure that everybody never falls behind on their laws and they always know what to do and how to do it, the government says we need to make sure that these guys are getting annual continued education. So every year you need to take a minimum of 8 hours. Some states do require more. All right, you do not get credit for the same continued education course if you take the same one every year. Every year your information has to be new content. At Loan Officer School, we create a new program every single year, so you never have to worry about whether or not you've taken that course before. So once again, we can be your one-stop shop for all your licensing and education needs. Now, Truth in Lending Act, this is the TILA. This is the Godzilla of the lending laws. This is the one that is big, it's detailed, and you need to know all about it. All right, now the Truth in Lending Act used to report to the Federal Reserve Board, but now it reports to the CFPB because back when the law was created in 2010, the Dodd-Frank Act said we're going to create this overseeing agency called the CFPB. Everything finance related is going to be going under the CFPB, one central agency to monitor all the financial laws to make sure everybody's on the same page. Again, it is implemented by Regulation Z. You'll remember that because TILA is the Godzilla of the lending laws. This law prevents abuses in consumer credit costs. What that basically means is how much the borrower is paying, the borrower deserves to know. So you want to make sure that you are always giving the legal disclosures that are uniform across the country to make sure that you're always giving the borrower the information they need in order to get a home loan. Now, the Truth in Lending Act does not set limits on how much you can charge or how much rate you can have. It just says you have to disclose this information to the borrower. That's what you want to make sure that you're aware of. Now, the Truth in Lending Act, something else that they do is called require a rescission period. Rescission, to rescind, which means to change your mind or to go backwards, right? So once you sign your loan documents, which is called closing on the East Coast but signing on the West Coast, that is where you're basically sealing the deal. But on a refinance, you can change your mind up to 3 days later. Now, we'll get into a little bit later about what's a business day, right? It's not 3 calendar days, it's 3 business days. Business days is Monday through Saturday, excluding Sundays and holidays, okay? So that's considered a business day. And the Truth in Lending Act says you have a 3-day right to change your mind and not go through with the loan 3 business days or up to 3 business days after you have signed your loan documents. Now, this applies to pretty much any residential mortgage loan that is subject to a finance charge, which means basically you're paying interest or other fees to get the loan, and you are paying that loan back in more than 4 installments, so basically 5 or more installments. If anybody's like a late night television watcher and all the infomercials are on, it's always in 4 installments or less. You want to know why? Because they don't want to have to adhere to the Truth in Lending Act because it's paid by more than 4 installments. Now, unless they were charging you more for having the 4 installments, then it wouldn't apply to anyway, but that's the main reason why most infomercials say in 4 installments or less, because they don't want to get into any issues with the Truth in Lending Act. All right, covered transactions. Mortgage loans you do that fall under this big law. Now, this part can be a little bit tricky. There's the law of truth in lending. There is the law of RESPA. Those laws require certain rules be followed underneath them. However, depending on the type of transaction you do or that you're working on, you're going to have different disclosures. So under Truth in Lending, you have a certain number of disclosures on certain transactions. Under RESPA, the Real Estate Settlement Procedures Act, you have different disclosures that have to be given on certain transactions. However, if you have a different type of transaction, then you have what's called TRID. TRID sounds kind of like a illness or a disease you need to go to the hospital for, right? You got TRID, but what it means is the Truth in Lending and RESPA integrated disclosures. So depending on the type of transaction or loan you're working on, you will either give TILA disclosures and RESPA disclosures, and other transactions you will give the TRID disclosures. Okay, and we're going to get into, again, all of the different disclosures that are required under each law and the combined set. All right, so basically, again, TILA laws apply to any residential transaction. Conventional loans, government loans, purchases, refinances, reverse mortgages, EIO mortgages, it doesn't matter. Any pretty much loan that is done on a residence is going to fall under the Truth in Lending Act. Now, depending on what type of loan you do will determine which disclosures you are going to give. That's what I was talking about right here. TRID, okay, that's the Truth in Lending, RESPA, integrated disclosure. TRID disclosures are not used on home equity lines of credit, something we call HELOCs. Reverse mortgages, mortgages that are secured by a mobile home or a dwelling that basically is not permanently attached. Sometimes we also call this a chattel loan. A chattel loan is one that covers personal property. That's not going to fall under the Truth in Lending Act. All right, or it's going to fall under the Truth in Lending Act, not under your TRID disclosures. All right, and loans made to somebody who is not considered a creditor. And you might be wondering, how can somebody do loans and not be considered a creditor? Well, it could be somebody who just has a lot of money and they sell a house and they carry the note. That would be called a seller carryback. If that were the case, then, and that person does less than 5 or less loans a year, then they're not considered a creditor and they don't have to fall under any of these laws and restrictions. All right, now again, if you're doing a transaction pretty much other than one of these, then you are going to have to use, other than one of those, you're going to have to use the standard TILA disclosures. Your standard TILA disclosures is going to be your Truth in Lending Statement and Guide, okay? So that's gonna be, if you're doing a HELOC, a home equity line of credit, you are not gonna use the TRID disclosures, you're gonna use the Truth in Lending disclosures. So TILA disclosures apply to all of those items listed on the last page. So the Truth in Lending Statement and Guide is one of the disclosures you are going to be providing. When your home is on the line booklet is something specific that will be given under the Truth in Lending Act for HELOCs, okay? Now, a HELOC is gonna have this Truth in Lending Statement and Guide and the When Your Home is on the Line booklet. They're not independent, they are used together. All right, the CHARM booklet. The CHARM booklet is not very charming, trust me. The CHARM booklet stands for Consumer Handbook on Adjustable Rate Mortgages. So if you have a 30-year fixed rate loan, are you going to give the CHARM booklet? No, because it's not an adjustable rate mortgage. This is an additional disclosure that is given only if your loan is an adjustable rate or an ARM. All right, also separately, you're gonna have a different ARM disclosure. What this one here does, the CHARM booklet, this one is an overview of how ARMs work. This one is an ARM disclosure that is specific to your mortgage loan, okay? So those two items will be given in addition to the Truth in Lending Statement and Guide if you have an adjustable rate mortgage. And a balloon disclosure. A balloon disclosure is one where you're gonna pay off the loan in full before the end of the amortized term. Let me show you an example of what I mean. Most people have heard of a balloon loan or a 30 due in 15. Now this can be written like this, 30, 15. I have the worst penmanship, so just bear with me. All right, 30 due in 15. That means your loan payments are going to be spread out over a 30-year time frame. So it feels like you've got a 30-year loan, but you don't. In the 15th year, you're going to be required to pay that loan off in full. It blows up like a balloon, okay? So 30 due in 15 would be what I'm referring to here. That would require the balloon disclosure. Now this can also be written as a 360 180. This is the number of months in 30 years. There's 360 months in 30 years, and there's 180 months in 15 years. So that would be what we're referring to when I say a balloon loan. All right, if your loan has a prepayment penalty, that means that your loan, if you pay it off in full before an agreed to time frame, that you will have this extra penalty. Now it's usually calculated by 6 months of interest on the remaining principal. Okay, so what you're going to do is take the loan amount you have and multiply it by the interest rate. That's a whole year of interest. Divide by 2 so that you get the 6 months. So if you pay off your loan, let's say for example, you have a 2-year prepayment penalty agreement. It means you will not pay off the loan in less than 2 years. So anytime before the 24th month, if you pay off that loan in full, you're gonna have to pay a penalty. And that penalty is gonna be 6 months of interest on the remaining principal. All right, now, TILA, the Law of Truth in Lending, says you must maintain and hold on to your Truth in Lending disclosures for a minimum of 2 years. Now that's the national requirement. States can be more strict, so Make sure you are aware of what your state requirements and limitations are. Do they require the national standard of 2 years, or do they want you to hold on to your disclosures for a longer period of time? It's your job as a loan originator and your job as, working for a company and your company's requirements as well, to know the laws in the states you are doing loans in. All right, application. You're going to hear me refer a lot to an application, and when you take an application, certain disclosures are required. Well, an application isn't really a fully completed, written and signed application. It's when you've obtained 6 core pieces of information. I remember that an application is pencil. Okay, that's how I remember what an application is considered. An application is considered an application when you've obtained pencil. The P is the property address. All right, now if you don't know the property address, then you don't have to worry about giving disclosures because you're missing one of the key components. E is estimated value. N is name. C is credit, I is income, and L is loan amount. So if you spell out the word pencil, pencil gives you the loan application. So if you've received the address, the property address, the estimated value, that could be an appraisal or it could just be a guess of what the property is worth, name, credit, or the social security number in order to obtain credit, okay, income and loan amount, then you have obtained a full application and you need to provide disclosures. If any one of those items is missing, you do not have to give disclosures. You haven't taken what's considered an official application. All right, now when you give the truth in lending disclosure, this is something important to know. The federal box is 4 boxes and all of them make up the federal box. The federal box includes the annual percentage rate. This is not the same thing as your note rate. All right, you could be paying, as you see here, a 6.178 annual percentage rate, but you're probably going to be paying more like 6 or 5 3/4 on your note rate. What this is the rate you are paying plus the costs to get that loan, like your escrow fees, your lender fees, your credit report fee, your appraisal fee, all those fees added together, combined with the note rate, spread out over the life of the loan, and converted into one percentage number. It is the single most confusing number known to man. Like, very few people actually understand APR. So if you see annual percentage rate, that's not the same thing as your note rate, okay? So the APR, or the annual percentage rate, must be on your truth in lending disclosure. The finance charge, this is the dollar amount you are paying for the financing, all right? This would be like all of the interest added up over the course of the loan and all the costs you paid up front. That's your finance charge. That's the amount you're paying the company to give you the loan. Amount financed is the amount basically of your principal, the amount that you are getting before all the other charges are charged. All right, and then the total of payments. This is the total amount that you're going to pay back over the entire course of the loan, assuming, of course, that you never made any additional payments. So these 4 boxes, all included, are considered your federal box. And note again, it does not include the note rate. Now, on every truth in lending statement, you have to have what's called the mandatory statement. It's just a statement on this disclosure that informs the borrower you are not required to complete this agreement merely because you have received these disclosures or have signed a loan application. All right, that is mandatory. You don't have to handwrite that in. It's pre-populated on the truth in lending form through your processing software. All right, now there's a lot of other data that's on the truth in lending disclosure as well. Not terribly complicated, all stuff that makes sense, the details of your payment, when they're due, what happens if you're late, name of the lender, description and identification of the type of security instrument you're getting, like again, a home loan or something along those lines. All right, and if the loan is assumable. So these other items are on the truth in lending disclosure as well. Now, not all fees are included in the APR. Some are and some aren't. pretty much all of the fees that go along with the financing, with getting the loan. These are primarily the lender's fees, the broker's fees, and the escrow fees. Those are typically the fees that are included in the annual percentage rate. Lender fees, broker fees, and escrow fees. Title fees are never included. Here's a way you can kind of guesstimate if it's an included fee or not. If you were to pay cash for a house, you just are rich, you're Warren Buffett, you're going to pay cash for a house, and there is no loan, but you're going to pay this fee anyway, then it is not an APR fee because there's no financing. That's what APR is for, is to show you about the financing. So if you're paying this fee because you got a loan, that's going to be an APR fee. For example, every lender is going to require an appraisal and a credit report and a flood certification. They're going to probably have an underwriting fee and a processing fee. Those fees are associated with the lender, and they require those fees in order to give you the loan, okay? APR fee. No loan, no fee, doesn't get included in the APR, all right? But these are some of the APRs, APR affecting fees, so the fees that are included in that APR, and these are a lot of the fees that are not. Now, there's an asterisk by the appraisal fee for a reason. Sometimes, depending on when you collect the appraisal fee, it will either be included or not be included. And you might be thinking, well, that makes absolutely no sense because the appraisal is required by the lender, so why is it's sometimes included and sometimes not? If you collect the appraisal fee up front, then it's not going to be included because we don't know whether or not you're actually going to get that loan. If you pay for the appraisal fee, like the lender was just going to front the money and pay for it for you, and you don't have to pay for it until closing, if it's paid at closing, it is included in the APR simply because we know you're getting a loan, right? We are getting financing. Therefore, this is a done deal. We are going to include that because we know you're getting a loan. All right. So again, it's always subject to financing. So that's why appraisal fee is sometimes included and sometimes not. And all these other items are typically excluded from the APR. All right, rescission. I mentioned this one a little bit ago. Rescission is your 3-day right to change your mind, but it doesn't apply in all transactions. Purchases and non-owner occupied or investment properties, a property you're just going to rent out, that is not a rescindable loan. Okay, rescission means the day you sign, you have 3 business days after that day to change your mind and no longer go through with the loan, even though you basically signed the contract. That's your 3-day cooling off or changing your mind period, okay? Now remember, it's business days, which is Monday through Saturday, excluding or not including Sundays and holidays. All right, so again, it's the right to withdraw from a contract. It applies to a principal residence only, so not that, not a second home and not a non-owner or an investment property. Extends to the 3rd business day, and your right to change your mind or your right to rescind must be disclosed when you are signing, and by signing I mean closing. This rescindable disclosure does not apply to a purchase, construction loan, commercial loan, vacation or second homes. Some refinances that are consolidating loans by the same creditor or state agency creditors do not have to have a rescission. So these loans basically don't fall into rescission. Really, in the big picture, it is an owner-occupied primary residence refinance. Those are the loans that require the rescission. All right. If one person on the loan decides to rescind, it affects the entire loan. So let's say, for example, me and my husband are getting a loan. I wake up at 3 o'clock in the morning and I am not comfortable with this transaction. I sign the rescission and send it in. Well, that cancels the loan for my husband too. If he wanted to move in or he still wanted to go through with it, doesn't matter. I just cancel the loan for the both of us. If you're buying it with just somebody who's not a spouse, same rule applies. If you and your best friend are buying a house together and you decide you don't like the loan and your best friend decides that they still do, you cancel the loan, it cancels it for everyone. That whole loan now has to be completely recreated if one party decides they don't want to be in it. All right. If you have rescinded, the lender has 20 calendar days to refund you the money you've paid up front because the loan never went through. Basically, they have to make it as if it never ever happened. This does relieve the borrower of all financial liability. Once they sign the rescission, you are done. You do not have a contract. The loan did not go through. The right of rescission extends, as I said before, to the third business day at midnight. So if today's Monday, Tuesday, Wednesday, Thursday, assuming there are no holidays in there anywhere, then the loan rescission expires Thursday at midnight. If you sign the rescission Friday morning, too late. You missed your window, and that loan's going to have to go through. Now, there's also something called an extended rescission. An extended rescission is if the lender didn't do something correctly by the closing date and the loan closed and you figure it out after the fact, you can still rescind up to 3 years later. So let me give you an example. Let's say it's, I don't know, January 2017, okay? And you do a loan. And a year later, you go back to refinance that loan. Now it's 2018, okay? In 2018, your new loan officer says, let me see your old loan documents so that I know what your terms and conditions were. So I know if there's anything I have to override now. So you look at, you provide your truth in lending and all of your other prior documents, and the loan officer says, you know, this math isn't adding up. I think your APR was underdisclosed, which means they told you your annual percentage rate was actually lower than it really was. It was something higher than they told you. And these are, you know, all these disclosures are subject to the information you put in it. Somebody could have just made a mistake. So what you do, instead of just going through the loan process and moving forward, you go find yourself an attorney and you show all of your documents. And then that lender says, or I'm sorry, the attorney says, hey, Shar, you're correct. These fees don't add up. Your APR should have been X and they told you it was this. So we're going to go ahead and take that lender to court. And if they do and they provide that documentation, basically you lived in that house with a free loan for up to 3 years. If the lender didn't do their job right in the first place, you can go back 3 years later and say, hey, you didn't do your job right. I've got an attorney. They file suit, and generally somebody's going to settle. And ultimately what happens? The lender lets you out of the loan and does one of two things. All right, we're going to start from scratch this day with the correct disclosure. So you got basically 3 years of living in that house loan free. Or they will make you refinance and get another loan because now they're scared to deal with you ever again. So they don't want you on their books anymore. And the judge can say you can keep the loan if the lender's willing to keep you. And basically they refund all of the fees that you paid and basically reimbursed all the interest and all the fees that you had paid over the last 3 years. You start fresh from now. Or go get yourself another loan. As soon as that loan closes, the lender's going to reimburse you for all the costs that you had for the loan, not for the house. If you had a sewer break and you had to go get it fixed, they're not going to cover that, just the costs to your loan. You get all that back and you have a new loan. So ultimately, like I said, you lived in that house for 3 years with no loan costs. All right, so lenders really want to make sure they do their job in the disclosing properly. All right, so if they fail to properly disclose, then you have the 3-year right of rescission. If the creditor fails to give you the disclosures that you should have received, sometimes one, I don't know, fell out of the envelope and they forgot to have you sign it, then that's not giving you the disclosures that you're entitled to. If a disclosed finance charge was less than what you said it was going to be, so basically, if the finance charge, that's a dollar amount, is off by more or is understated by more than 0.5% or $100 and they don't correct it after closing, then too bad, so sad for that lender. You just got yourself a free loan, but you do have to get an attorney and file suit for it. All right, that is on a regular transaction, the 0.5%. A regular transaction is basically a 30-year fixed rate loan. If there's any payment or rate change during the course of your loan, then you're going to fit into an irregular transaction, and that's when you have a 1% margin for error. All right, now, If you have this extended rescission period, it will be canceled. The extended rescission time frame of 3 years is eliminated if you expire the 3 years, so that 3 years ticks. You can't, 7 years from now go back and say, oops, you guys did it wrong. You have to have discovery within the first 3 years. If you transfer interest in the home, or on the property. So let's say I transfer title to my mom, okay? I'm no longer the person of interest on that property. My mom is. I just lost my right. So this is one of those things. If you sell the house and you're no longer on title to it, you cannot go back and say, wait a minute, you guys screwed up on my disclosures. I want my money back. Too bad, so sad, you're lost. You needed to figure it out while you were the interested party. And last but not least, if you sell the house, you're done. You can't go back and try and go for past claims that have already occurred because you already sold the property. All right, extended rescission will also expire in 3 years if, the extended rescission period for 3 years if the failure to properly notify consumers of the right to rescind. Now this is, again, you have to know about your right to change your mind. The truth in lending disclosures are required to be accurate. They can't just slap any numbers they want onto the form. So what's going to happen is if your APR, the annual percentage rate, is under-disclosed by more than an eighth, which is 0.125, an eighth on a fixed rate loan or a quarter on an adjustable rate loan. And it couldn't just be adjustable like balloons or any, again, non-30-year fixed rate loan. These are your variances, okay? So if the APR is understated, you said it was lower than what it really was by an eighth on a fixed or a quarter on any other type of loan, then you have to either redisclose or you're going to have that 3-year extended rescission period.